What is small bay industrial real estate? Most investors skip over small bay industrial, but it might be one of the most stable, cash flowing real estate asset categories that are out there in the market. These aren't massive warehouses. They're 1 to 5,000 square feet, rented by tradesmen and home service companies in a variety of businesses, and they are performing quietly in a noisy real estate market. So by the end of this video, you're going to understand what is small bay industrial real estate. Why is it performing so well? And how does it fit into a solid cash flowing real estate portfolio? Check it out. So what does small bay industrial mean? These are multi-tenant industrial properties made up of smaller bays, or AKA units, usually 1 to 5,000 square feet per unit. Each unit typically has its own warehouse space where there's a roll-up door, an office, and a bathroom. Each unit has its own separate warehouse, sometimes with an office, sometimes with a bathroom, but it's a small industrial warehouse space. Many of these properties are consisting of multi-tenants, anywhere from 5 to 50 tenants within a business park. These are small bay contractor units, also called contractor bays, also called sometimes flex space, but that's a little more revolving around office. Small bay industrial is small warehousing space. You want to think of contractors, tradespeople, small logistics companies. These are businesses that need physical space to operate out of. So when you think of these types of tenants, what you want to think of are the people that serve most of our home services, or the small distribution companies that need to get their supplies throughout the regions that they work in. HVAC companies, electricians, cabinet shops, e-commerce shoppers, flooring installers, anyone that's working on your home. And what I love about these tenants is you can't outsource them to China. The hard work still needs to be done. I was watching an AI video the other day, and one of the godfathers of AI said if he had to train his son to be in a profession, he'd tell him to be a plumber. Because right now, you cannot outsource plumbing. It needs to be done. So that's why this space is in critical demand. And there's almost 1 million units across the United States. And out of those 1 million units, there's 95% plus occupancy. So there's a very high demand, and there's very little supply. The reason there's little supply is the institutional real estate market, the investors, they wanted to build warehouses for Amazon and IKEA and all the large distribution and manufacturing companies that are Fortune 500 or Fortune 1000 companies globally. And those are the credit tenants. But the perceived non-credit tenants need 1,000, 5,000 square feet. They don't need a lot of space, but yet they are providing services for entire American population. So there wasn't a lot of development in this asset class. So there's properties that are 40, 30, 20 years old that have not been built in the last 10, 20 years because it wasn't a popular space for the investment community. The great thing about these assets is the tenants are sticky, meaning they don't leave that often. So if they have a business, a small business they operate out of with an office and a bathroom and a warehouse, they can grow and scale that business and even take up multiple units within the property. And they're going to operate their business because they're regionally focused on doing services for people in the area or holding supplies in the area that they're going to need to execute on the work that they have. Why this asset class matters right now? Well, post-COVID, I don't know if you've seen it, but home services companies have exploded. Roofing companies, paving companies, siding companies, HVAC companies, garage door companies. A good friend of mine just sold his company a few years ago for $1 billion, and they installed garage doors throughout the Southwest United States. So private equity loves this space because it's guaranteed revenue. This work needs to be done, and it's scalable, and there's lack of competition. We're not teaching trades in the schools, so there's not a lot of new competitors coming in the market, and it's a highly valuable asset class right now. And one of the reasons small bay works for these types of tenants is because they're not fancy, they're affordable. They don't care about the look of their office. They need a simple office, bathroom, and they need warehouse space that they can work on their equipment or store their materials, get in and out, have excessive parking for their fleet of trucks, and have a cheap space to work out of where they're not paying heavy office prices or retail prices where they don't even need those spaces. They need the warehouse. From an investor standpoint, why are these properties so lucrative? Well, high margins. These buildings mostly are consisting of concrete and metal. There's an HVAC unit, there's some lighting, there's possibly some fencing. There's some parking lot paving, but there is not a lot of maintenance on these assets. So the repairs and maintenance are minimal compared to other real estate asset categories. And as an investor, why I love them for value add is the older product, 20, 30, 40 years old, is easy to improve. Fixing the roof, fixing the asphalt or the parking lot, fixing the signage on the property, fixing the lighting. These are all minor improvements rather than having to develop from the ground up or completely tearing half of the building apart and rebuilding it to high tenant improvement specs that many retail or office tenants are going to need. That's a high cost and it lowers your return on your investment. Investors and lenders love these assets because of the diversification of income. There's a diversification of tenants. I've invested in big box retail, large industrial warehouses, and those tenants are risky. When you have one tenant that can take out 30, 40, 50, or up to 100% of your revenue, you are at risk with that tenant and all the cash flow goes away. Why I love small bay industrial is because you have 10, 20, 30 tenants. And when one tenant leaves, you can backfill that tenant with another occupied revenue source. This spreads the risk and creates steady cash flow. And typically the leases are tiered, where some of the leases are year to year, some of them are 3 years or 5 years, but they're staggered. And the fact that they're staggered allows you to prepare to be able to backfill tenants that are going to be leaving, and you're never left with a huge vacancy at the property. And then also there's triple net rents. So you can bill back the property maintenance. You could bill back the management. You could bill back the utilities to the tenant. You could bill back the taxes and insurance. And this will allow you to drive higher margins and reduce your expenses and still be competitive with other property types. So where are we buying now? At Patriot Holdings, my private equity firm, we focus on buying real estate, and I love small bay industrial. Right now, I'm looking at regions in the Northeast. I'm looking in the Midwest. I'm looking in Texas. I'm looking in the Southwest. I want areas that have housing growth or cost of housing is prohibitive to buy or build new housing, where people need to maintain their houses. And there's a lot of tradesmen in an area that have to have a space to occupy out of. They can't do it out of their house after they reach a certain scale in their business size. My dad's a paver. He has a paving company, and he can't park all his trucks in front of his house. He has many different people that work for him in his fleet. So he needs a small bay warehouse to have his office out of, and then all of his trucks parked in the back. And this is what all of these guys need in order to be able to serve their customers. So I'm looking for regions of the country where there's good jobs so people can afford to pay the contractors to work on their homes. And there's growth or there's stable industry in that region, like colleges, like unique manufacturing, like a wealthy demographic. And that's where these assets thrive the most. Where I don't buy is low income markets. The rents are just too cheap. I don't look in parts of the southern United States because the rents don't justify the cost of the property. Also, I don't invest in core markets typically because it's hard to find a good cash flow yield buying in the heart of New York or right on the outside of New York or the heart of LA. Those markets have minimal cash flow. So I'm looking to be on the suburban markets or the outskirts of larger markets like the outskirts of Phoenix or Boston or Chicago or Houston. These are going to be markets that have lots of trades, and still you can find properties that are mismanaged and you can raise rents to drive cash flow. Now, should you develop or should you buy existing? Well, for us, I've developed, and I'm going to do a whole separate video on that. That's not an easy game. Development's a whole different animal. Value add is all about finding mismanaged properties that you can buy at a bulletproof basis. You're buying below replacement cost. If it costs you $100 to $150 a foot to build this product plus land, and you can buy a property for $60, $70, $80 per square foot, you're already in the money. Now, yes, there's deferred maintenance. You want to add on to that, but that's a lot easier project than going out there and trying to build from the ground up. So right now we're looking for those mismanaged properties where you can go in, advertise the units, expose them to a bigger pool of tenants that are great industrial contractors, or they're great home service guys or warehouse guys, or just guys that need storage, that need to go to a place and store their cars or their different things in their home that they want to get out of the house. There's a large tenant pool there. I highly suggest focusing on value add and buying existing right now. So now that you know about small bay industrial, I want to let you know that I got a free gift for you. It's my book. It's called Finding Your Edge, How to Win at the Game of Commercial Real Estate Investing. I wrote it myself, no ChatGPT. It's also on Audible. So it's my story about buying real estate. I didn't have any money, didn't come from money, learning the game and the 6 principles it took to be a professional real estate investor. So click on the link in the comments below. I'll send you out a copy of the book. If you're interested in real estate investing, then this will help you eliminate tons of dumb mistakes. I made plenty, and how to spot great deals, find them off market, and then close on them, build a team, and provide excessive returns, outpace the market, getting 20, 30, 40% ROIs, and building wealth. That's what it's about. Long-term wealth. Real estate's playing long-term games with long-term people, and that's how I built my career. So check it out below, and I'll send you the book. Thanks.